Hello everybody, this is lesson 13 of the lecture International Economics. I will discuss slides 143 to 150 of chapter 2, Major Market Segments and Their Assets. In this lecture we will talk about the various possibilities private companies have to hedge the exchange rate risk from selling goods or services to other currency areas. We will explore three alternative ways to use derivatives to hedge the exchange rate risk from a firm engaged in international trade with goods and services. Consider the problem of the exchange rate risk as described by the following graph. Let's analyze the exchange rate risk of a typical commercial deal of a private company which sells goods to clients in other currency areas. Let's assume a European car producer sells a car to a client in the dollar area at a price of $20,000, while the production costs for this car equal 9,000 euro. Since the car producer produces the car in the euro area, the production costs must typically be paid in euro. So, as a result, we have a currency discrepancy. The revenue will come in dollar while the costs have to be paid in euro. Now, what makes this problem worse is the fact that dollar payment of such an international commercial deal will typically be paid in the future. For example, 3 months forward, when the car has arrived at the client in the United States and can be inspected by this client. Now let's assume that the current spot exchange rate equals $2 per euro, while the future spot exchange rate 3 months ahead is of course unknown. Given the spot exchange rate of $2 per euro, the deal would yield a profit of 1,000 euro, since the incoming $20,000 will equal 10,000 euro minus production costs of a car, leave a profit of 1,000 euro. We do, however, not know what the future spot rate will be. If 3 months ahead the current spot rate were still given, a profitable deal would be possible. However, a depreciation of the dollar to a level of, let's say, $2.5 for 1 euro is as well possible. And in this case, a loss would result, because $20,000 over $2.5 per euro yields only a sales return of 8,000 euro, which would not be sufficient to cover the costs of 9,000 euro. So a loss of minus 1,000 euro would be the result. And this potential risk of a loss that depends on the movement of the spot exchange rate is what we call the exchange rate risk. If companies could not protect themselves against such exchange rate risks, they would only agree to such international commercial deals where the profit margin is high enough that the exchange rate risk is compensated. International trade with lower profit margins would therefore not be undertaken. Hence, exchange rate risk would hamper international trade in a similar way as transportation costs or tariffs do. However, international financial markets offer various possibilities to hedge such exchange rate risks. Thus, these markets support, in this sense, also international trade with goods and services. We will discuss in the following three basic instruments that can be used to hedge exchange rate risk. First one is a foreign currency credit. The second one is a currency future, and the third one is a foreign currency option. A quite simple way to eliminate the exchange rate risk is a foreign currency credit. Let me use the commercial deal just explained 2 slides before to show how a foreign currency credit can be used to perfectly hedge the exchange rate risk. Let's assume the interest rate for a dollar credit with a maturity of 3 months is just 2% for simplicity. So if we take such a credit from, let's say, an American commercial bank, we can immediately exchange the dollar credit at the current spot exchange rate of $2 per euro. Hence, we would have a euro income equal to 10,000 euro minus our production cost yields a certain profit of 1,000 euro. In 3 months from now, we will then receive the dollar payment for the car equal to $20,000. Now we can use this money to pay back the credit which we had received 3 months before to the American bank. However, we have also to pay the interest. If the interest rate is 2%, we would have to pay a total amount of interest dollar to the American commercial bank equal to $400. 2% times $20,000 is 400. So these $400 have to be subtracted from our gross profit equal to 10,000 euro. At the spot exchange rate of $2 per euro, we need to subtract 200 euro from our gross profit in order to receive the net profit from this commercial transaction. So the net profit would be 800 euro. This is certain, since we know the interest costs in euro already at this point in time. We can certainly calculate that we will have a net profit equal to 800 euro 3 months ahead when the payment is made by the American client. So this is certain money. There's no risk now involved. Hence we have get rid of the exchange rate risk with a simple instrument like a foreign currency credit. Of course, the profit could be slightly increased if the interest money would not be kept in a cash drawer, as I have implicitly assumed here, but instead be used for an investment in a fixed rate security. This would provide a certain amount of interest payment over 3 months, so this would reduce somewhat the amount of money that we need for the interest payment, but for simplicity I have neglected this possibility. Another possibility to get rid of the exchange rate risk is the purchase of a currency future on the market for forward exchange. Let's assume that the current forward exchange rate payable at 3-month maturity equals $2.1 per euro. So if we sell $20,000 on the forward market at a forward exchange rate of $2.1 per euro, we can exchange 3 months from now the incoming $20,000 payment from our American client at the certain forward exchange rate of $2.1 per euro. This yields a certain euro sales income of 9,523, what equals a certain net profit of 523.8 euro. So again, here we have get rid of the exchange rate risk and have a certain profit, which we can already know at this point in time when we decide whether to make this deal or not. So this is another possibility to completely eliminate the exchange rate risk. The net profit here is a little bit smaller as before when we used foreign currency credit, but this depends of course on the special market conditions, and these market conditions can change of course in the course of time. Another possibility to eliminate the exchange rate risk completely is a currency option. A currency option allows the exchange of dollar to euro 3 months from now at an exchange rate fixed in advance, in the present. Let's assume that it is possible to buy an option to exchange $20,000 3 months in the future at an exchange rate of $2 per euro for an option premium of $0.05 for every dollar exchanged forward. So times $20,000, this equals $1,000 divided over the exchange rate, $2 per euro. This implies a costs for buying the option measured in euro of 500 euro. So this is the money we have to give away in order to buy the option. That helps us to get rid of the exchange rate risk. Now let's assume that 3 months ahead the spot exchange rate for dollar to euro is 2.4. So the euro has appreciated. In this case, we would of course exercise the option, since the option allows us to exchange our $20,000 sales income at a better exchange rate, where the dollar has a higher value compared to the euro. We have to give away only $2 for 1 euro instead of $2.4 for 1 euro. So in this case, we would exercise the option, would have a euro income of 10,000 euro minus our euro production costs, leaves us a gross profit of 1,000 euro. So The certain net profit in this case, when we exercise the option, is equal to 500 euro. This is the minimum net profit we can make based on this deal if we hedge the exchange rate risk with a currency option. Now, the advantage of using an option is that we have not the obligation to make use of it. So, in case the dollar would not depreciate but appreciate compared to this spot exchange rate, we could use this possibility and exchange our dollar income at a better exchange rate. This is shown by the next example. So if the dollar appreciates versus the euro to a spot exchange rate of, let's say, $1.8 per euro, then we could use our right not to use the option and instead exchange the incoming $20,000 at the spot exchange rate 3 months ahead. In this case, we would receive more euro for these $20,000, namely $20,000 over $1.8 per euro yields, roughly spoken, 11,111 euro minus our euro production costs leaves a gross profit of 2,111 euro. As a result, the net profit would now equal 1,611 euro instead of the 500 euro which we would receive if we made use of the option. So in fact, employing such an option to hedge the exchange rate risk offers possibility to combine an insurance against the depreciation of the dollar with a speculation for an appreciation of the dollar. These three examples show that in a system of flexible exchange rates, private companies do not necessarily have to suffer from exchange rate risk. So, international trade is possible without exchange rate risk, if we have free access to international financial markets that offer us the possibilities we have just discussed. In the next lecture, we will start with Chapter 3, where we discuss the influence of central banks on international financial markets.